Okay, thank you for attending today's 7 principles for generating retirement cash flow. Before I start, I really want to thank Janice Henderson and our speaker, Ruben Gonzalez. Mr. Gonzalez is going to go over the 7 principles for generating retirement cash flow, which is making your money last, diversifying your assets, time period, asset management, investment risk, taxes matter, maximizing Social Security benefits, and guarantee income solutions. It's pretty, very complete, I'll say. So I really look forward to it. Normally when I start any session, I just want to make it fun. So I'm going to ask you a trivia question. People who do know it or think they know it, please help, okay? So the first, the trivia question that I want to ask is like, what is the ideal retirement saving at retirement? What do you think? Pat, you always have an answer. What is it?
$1 million?
Huh?
$1 million.
$1 million? Yes. Oh, wait. Okay. So let me just share with you, this is from Fidelity. Okay. So, at retirement, assuming that maybe at 67, you should have 10 times your pre-retirement income. So if you make 50, you should aim for 500,000. If you make 100, you should aim for $1 million. So Pat, maybe you have $2 million, right? I'm just joking. Sorry. This is joking. Okay. I'm pulling your leg. Sorry. Don't take it too seriously. But what it's pretty sad if you look at the reality. So this other slide will show you like what people actually have for retirement savings at different age. And then 30% of the people age 55 or older have nothing saved for retirement, and 26% save less than $50,000. So most of the people who actually, the top 10%, top 1% got lots of money, but a lot of us is still kind of struggling. So if we can continue to save, we should try as much as possible. So that's it. I'm going to give it to Paul from Janice Henderson to introduce our speaker today. Paul, are you there?
Yeah, I appreciate that, Bonnie. So yes, my name is Paul Citarella from Janice Henderson and Investors. I'm out in Denver, Colorado. But our speaker today, Ruben, is a little bit closer to you, lives in Connecticut and went to Manhattan College. Ruben is our retirement director for the Northeast. He's worked with Janice Henderson since 2015. Before that, he was with Deutsche Bank. I have the pleasure of working with folks like Bonnie, and I mostly focus on the investment side of things, but Ruben's specialty is really on the education component and specifically in retirement. So he's a tremendous resource that I'm able to connect people like Bonnie with, and I think you'll really enjoy hearing his comments today. Ruben, it looks like we can see the notes on the screen, so if you change the format.
Well, thank you. All right. How's that?
We still see it.
Oy.
It's the same.
One moment, please. Sorry, guys. I gotta get my settings right. So whenever we do these things, it's always tricky with the settings. Let me see if I turn off my screen.
I always spend about 5 or 10 minutes on these meetings getting my screens adjusted.
Pat, I thank you for that as a kindred spirit. I mean, I do these things ad nauseum. You would think I would have it to a science, but apparently, it's just not behaving for me.
Yeah, you got it. You got it. Yep.
Is that do you see the slides? No.
I see the slide, but I see the notes at the bottom. At least it's not.
Yeah, no, that's not what that's not what I'm
good. You got it.
Thankfully. Okay, guys.
Thank you.
Thank you. Good Lord.
Yay.
So as Paul was saying, one of the things that Paul left out into his credit, I've been doing this for 25 years. And so I've had the pleasure of working with plan sponsors, with participants. And, throughout those years, you kind of get the same questions being asked. And, as you all know, that as we approach retirement, what do you do if, I was retiring in say, 2020? The markets are going up, they're going down by 30% or more. So that's issue number one. Issue number two, we don't talk about this a lot in this particular presentation. We have another presentation, by the way, if you're interested. From a behavioral finance standpoint, do we have any hobbies? Do we have a large family that we can spend time with in retirement? That sounds trite. It sounds simple, but a lot of people do not. And that also affects our spending, how much we need to live off of in retirement, et cetera. So, this is almost like a holistic approach as we get near and through retirement. So we have about 40 minutes today, and I'm going to turn off my my screen here. Oh, great. Here we go. Okay, so I'm going to turn off my screen, and we'll jump into it. Bonnie, I don't know if you want to keep questions till the end, or if you want to stop as we go. I'll leave that up to you, but please, let me know or flag me down if you want me to stop. Okay.
Okay, good.
Okay. So let's jump right into it. And here is, okay. By the way, these are the 7 principles that we'll get to. I'm not going to get a lot into guaranteed income solutions because that's sort of a niche and depending on your worldview, a controversial topic. It does have a place, I will say that. But we'll talk about it in a high level. Okay. So one of the challenges that a lot of people in retirement, or as they get closer to retirement, face is, that they're healthy and they're living longer, right? Now, that's not bad news to anybody here on the call. That's actually great news. But what that means is that your money has to last, right? For, in some cases, and Bonnie and I were talking about this before we started the call, 20, 30, if you hit the genetic lottery, 35 years in retirement. How do you not run out of money, right? So, and that's the biggest challenge that Americans are facing. And one of the things that you have to keep in mind too, and this comes from Time magazine, for those of us who still read magazines, they state that the first person to live to be 150 years old has been born. I hope I'm not that person. I don't know if I could sign on for 150 guys, but you get the problem. Right? It's like we do our best saving as much money as we can. And let's say we have our wits about us, we're healthy, and we're pushing 100 or 110. That creates challenges, obviously. The other issue that you have to consider is cost, right? We'll have inflation. Now, inflation hasn't been an issue in recent years, but we're starting to creep up with inflation. Historically speaking, as a benchmark, inflation, you can count on inflation being about 3% a year. Again, that's the average over time. So, again, things that we have to consider as we get closer to our retirement. So the question becomes, if this is taking all this in, how much can I afford to take out of my retirement savings on an annual basis, right? And so this is the trade-off, because on one hand, it's important to take out enough money to meet our daily living expenses. But on the other hand, you don't want to take out too much and leave yourself shortchanged. Again, if you hit the genetic lottery and you're living to 100 or 110. So over the last several years, a common rule of thumb, again, this is a rule of thumb, was typically using the 4% rule. And this essentially means that in year 1 of retirement, you're able to withdraw 4% of your starting balance. And then each year thereafter, you can increase that, your prior year's distribution, just to keep up with inflation, okay? However, over the last few years, there's been more research on this particular topic, and some authors and some sources contend that an individual might be able to have a withdrawal rate in excess of 4%, while others contend that maybe the right answer is less than 4%, maybe closer to 3%. The challenge here is there's no right answer, unfortunately. But we feel at Janus Henderson that a 4% is a good starting off point and good rule of thumb. Again, nothing more than a starting point, and to perhaps set expectations to move forward. Okay. So again, everyone's situation is going to be different. So this is a rule of thumb. So 4%, the 4% rule. One of the first things we'll suggest is, thinking about your cash flow in terms of priorities. So in other words, by prioritizing what you think is necessary versus what might be wanted is a helpful guide to help you make a rationalized, informed decision on your withdrawal strategies. So here are the three categories that we think about when we talk about prioritization of your cash flow, okay? So notice the largest category tends to be your needs. And these are things that are must-haves, right? And common categories for this would include housing, food, medical expenses, gas, for example, if you plan on traveling or working in retirement. The next category includes things like wants and things that we'd really like to have in retirement, right? But certainly they don't have the same necessity as perhaps a need. So within this category would be things like travel, hobbies, maybe a second home. And then finally, for many retirees, we have our wish list, right? So also deemed our bucket list. And these things are like charitable giving, maybe leaving a legacy behind for your heirs or future generations, things of that nature. Now, where people tend to get this mixed up is, and I'll give my mother as a perfect example, and she's not around, so I can talk about her. So needs, right? We all agree, housing, paying your rent, paying your mortgage if you still have one, is definitely a need. Food is a need. People start to confuse their wants with their needs. My mother loves to travel, and she requires since I can remember, she goes on vacation once a year. Now, for her, if you were to ask her, that would be a need for her. It's part of her mental health and what she likes to do. The reality, it's not, right? And so that's where we have to kind of take a step back and think about what our absolute needs are, because this is when you're doing financial planning for retirement, your needs, number one priority. And so the things that we're going to talk about will address your needs more than your wants or your wishes. Okay. So a tool that we find very helpful is something called a spending policy statement. Now, I'm sure you've heard of something called an investment policy statement, and that helps define your risk tolerance and your return objectives for your investments in your portfolio. Now, a spending policy statement is nothing more than a one-page tool that can help you rationalize and memorialize, in other words, write down your long-term goals as it applies to withdrawing money from your retirement accounts, okay? For example, spending policy statement may address what your monthly needs are and what your wants and wishes are, as we just outlined. Also, from which accounts will distributions be taken from? Under what circumstances will spending increase, and under what circumstances may spending be forced to decrease? So think early 2020, right? And then finally, how often will a spending policy statement be revised? Now, for some people, it might be an annual statement, or maybe they may want to revise it every quarter, right? More or less. Some people may ignore it altogether, right? Because this is a non-binding tool, but it kind of gives us our roadmap, and it helps us to make sense, particularly in times of turbulent markets like we saw in early 2020, when the markets were just whipsawing. Okay, so wrap up this particular section. The action steps are, first, a spending policy statement we think is a very helpful tool to help people stay on track and have a sustainable withdrawal system over the course of their retirement. Second, be sure to revisit and update your spending policy statement as needed. And finally, amend or revise it as your circumstances or your lifestyle may change, okay? Remember, the main point here is that we need to set spending expectations for different market environments. That's the big takeaway. So many investors are familiar with the concept of diversifying their portfolio. I don't think I have to explain that to anyone here. When you log on to view your savings accounts, you may find, that multicolored pie, the pie chart that shows the percentage that you hold in stocks, bonds, and cash. And that essentially helps you as an investor to think about the right percentages to put into your different asset classes. Now, the concept of portfolio diversification, however, sometimes gets a little tricky, right? Because often retirees have multiple accounts. You may have a traditional IRA, IRA rollover account, maybe a Roth IRA. Maybe there are balances from former employers, like a 401k or 403b account. And then you may also have a quote unquote taxable brokerage account, right? So while we do want to have a diversified portfolio in terms of the holdings, I would also contend that it's important. This is an important tool to have when it comes to asset location as well. And we'll talk a little bit more about that. Now, because people tend to have multiple types of savings accounts, it can be very difficult to keep track of money coming in or out of these various accounts. And perhaps money coming in like a pension or Social Security. So we suggest is to consolidate all of your different cash inflows into one depository account, as it were. And then use that depository account to meet your retirement expenses. So to help visualize this, think of a funnel, right? So you have many different streams of money coming into this account, but only one stream, it's all funneling into that one particular account. Surprisingly, a lot of people don't have this. Is why we're mentioning it. So the first thing we would suggest is setting up what we call this personal pension account. Basically, it's an interest-bearing account that has check writing privileges and can be used to pay bills. Okay. This is the account that we would encourage you to consolidate all your different cash inflows during retirement and use this one account to meet your retirement expenses. Not only does this make your life easier, but it also helps you track expenses and to make sure that you're on track with your overall retirement income strategy. So you can compare that to your spending policy statement just to make sure you're still in line in a given year. So here's a quick example of how this might work. A lot of people who are in retirement receive Social Security. Some have pensions or various IRAs, maybe a banking account, brokerage account. We suggest consolidate all these cash flows from all of these sources into your personal pension account, which can be set up, just about any financial institution, and then use that personal pension account to meet your expenses, which could be done via bill paying, check writing, ATM withdrawals, etc. One of the things, this sounds intuitive, but keep in mind, we all have a lot of accounts. I mean, I was surprised between my wife and I, we have 12 accounts actually, and that's these are just taxable accounts, which is ridiculous. So I'm working right now to sort of pare down, to eat my own cooking, as it were, and just to pare everything down. Okay. But here are your action steps. Again, we suggest you speak with your financial advisor as to what sort of personal pension account might be right for you. Again, it's got to be interest bearing. That's important, and you should also be able to write checks on it as well. All right, so principle 3, dividing a long-term investment plan into shorter, manageable periods. So for a lot of people in retirement, as we mentioned, longevity risk, right? So you can count on being retired for 20, 25, 30 years. So the thought of creating a long-term investment strategy for such a long time period can be very daunting because, honestly, we don't know what the tax rates are going to be 20 years from now, let alone 5 years from now. We don't know what our situation is going to be in 30 years or 20 years from now. So the challenge is, on one hand, keeping ample money available or liquid, right, to meet your daily expenses, while at the same time keeping a portion of your portfolio invested in growth-oriented investments to make sure that your portfolio keeps up with inflation. Remember, it's ballpark's about 3%, and it doesn't run out if you hit the genetic lottery and live to 100. So how do we do this? So one strategy that we suggest is where you divide your 20, 25, or 30-year retirement periods into a shorter, more manageable time period, right? Basically, what we're doing is creating a bucket system or a time segmentation system for your retirement. Now, for the short-term period, right, so the next 2 years, for example, we'd suggest having cash readily available and on deposit in that personal pension account that I just spoke about. This money can be used to meet any expense over the next 24 months. okay? And then for expenses that you're likely going to incur in years 3 through 10, we would suggest investing in more conservative investments to meet those specific needs, okay? These types of investments are likely to include bonds, okay? What a lot of people do in this bucket system is that they say, well, I have my emergency savings for 24 months. And then, you know, I may have a need in 3 to 5 or 3 years, let's say, or even better, 5 years from now. What they'll do is they'll go out and buy a 5-year bond to meet that particular expense that they plan on having. So that's how that would work. And then for years 10 and on, we would suggest investing in more aggressive investments like stocks, for example, to meet those needs, because we still need growth. We still need capital depreciation and compounding to make sure that our assets are there for us 25 or 30 years from now. So what you've done is that you've matched your most immediate retirement expenses, right, with your safest, most liquid investments like cash. And you've matched your longer term retirement income needs with your more aggressive investments like stocks, okay? Now, the big benefit is that, you know, over the next 24 months, regardless of what happens in the stock market, pandemic, whatever it is, you have the peace of mind that there's adequate liquidity there for your needs. And at the same time, your stocks and your other aggressive assets are working for you, being earmarked for those expenses that, you know, you won't incur for at least 10 years and longer, okay? So how do we get started with this, right? So the first thing we'd suggest is transferring interest from bonds and dividends from stocks that might come into your personal pension account each month, right? So that's going to help keep it full at all times for expenses and emergencies. Okay, as we discussed, you know, years 10 through 30, that's typically earmarked using equity or stock investments. So, for example, using I don't know, S&P 500 for your years 11 through 20, and or small cap and international stocks, which are a little bit more aggressive historically than large cap stocks for years 20 or more. So that's one way of doing it. Again, this is just a rule of thumb. You have to match it to your own personal risk profile as well. So overall, what the strategy is going to do for you is in the years following a positive market return, where you're able to rebalance in order to refill that personal pension account, you know, and on the flip side, in years following a negative market return, you simply stay the course. You don't do anything. You know, having the knowledge that you have liquidity available in your personal pension account, as well as sufficient bonds to carry your cash flow from years 3 to 10, for example. And in essence, this strategy helps you to avoid selling low and buying high. And this setup really allows you not to sell out of the stocks at the wrong possible time while growing your assets and protecting your income stream. Okay. Again, this is, I know many of you, this is intuitive, but there's something called behavioral finance. And this is not always logical when the markets are down 50% like they were in 2020. A lot of people made the mistake of selling at the wrong possible time. And I'm talking about people who are close or on the cusp of retiring. And it's going to be very difficult for them, if not impossible, to make up those losses. Okay. So in the current investment environment, one of the challenges that's facing retirees is a very low interest rate market, right? And unfortunately, in many cases, the interest rates that are offered by most securities are just too low for investors to be able to hold that position and live off their interest or income while saving or not touching their principal. Also, not only is that income, the income that's generated in today's environment too low to meet the necessary cash flow requirements, but over time, remember, inflation is going to erode an investor's standard of living. And again, you know, in the recent history, inflation has not been an issue. I think it's averaged like 1.8% or something to that effect. But we're starting to see inflation now. And so this is something that we have to kind of factor into our financial plan to make sure that we're generating enough interest, dividends, or yield so that our money is not eroded over time. So as a result of the low interest rate environment, a lot of investors, what they're doing is they're stretching for yield. I don't know if you've heard that term, or just looking for yield. Basically, they're selecting investments based on yield alone. And this might lead a lot of retirees to invest in different sorts of high yield investments, like preferred stocks that kick out large dividends, notably oil stocks or utility stocks. Real estate investment trusts also kick out very high yield, or something called a master limited partnership that tends to kick out high yield as well. Now, nothing wrong with any of these investments, as part of a diversified portfolio, of course. But I would caution, any investor making investment decisions based on yield alone to reevaluate that decision, and definitely speak with Bonnie or their financial advisor. Also, other investors are looking at the interest rate market or environment, and they're thinking, what impact is it going to have on bonds, right? Because as we know, when interest rates go up, bond prices go down, right? It's an inverse relationship and vice versa. So as a result, a lot of investors are shopping for bonds that have a long maturity, also known as duration, because those tend to pay a higher rate of interest. Other investors are looking at high yield or junk bonds, which again pay higher interest. But the thing to remember here is that these investments carry their own unique type of risks, right? With longer maturity bonds, they tend to be more sensitive to interest rate fluctuations. Bear that in mind. In other words, if interest rates go up, the value of these bonds will drop, and they'll drop faster or more deeply than short-term bonds. As far as high yield or junk bonds go, in order to entice investors by paying a higher coupon or yield, remember that these investments have credit risk, okay? So there's the possibility that investors may not receive the promised interest rate payment or their return of principal even in some cases. And also, junk bonds or high yield bond funds tend to trade like equity funds, or in other words, they're very volatile. So you have to keep that in mind too. So as an action step, we're big proponents of something called the total return approach. So in other words, being able to meet your cash flow needs from investments that generate both income as well as capital appreciation, growth of your assets. The income helps to meet obviously your immediate cash flow needs, and also helps to protect your principal during periods of market volatility. The capital appreciation portion of the portfolio helps maintain long-term purchasing power, right? Particularly in an inflationary environment like we're sort of entering right now. And this strategy will also help investors sort of minimize taxes, as the capital appreciation portion of their portfolio will probably be taxed at a more favorable rate, notably the long-term capital gains rate. So obviously when we retire, taxes matter, right? So what's really important to remember is that, most investors or retirees live on after-tax cash flow in retirement. And the income tax environment might help to generate additional after-tax cash flow. So here's a quick review of the tax tables for both single as well as married folks. There are two things to note, right? So the first thing is that we live in a progressive tax world. So in other words, the more income you have, the higher your tax rate, right? The second thing to note is that investments may be taxed in one of two ways. They may be taxed as ordinary income, or they may be taxed as a short-term or long-term capital gain rate. And of course, we all know that the long-term capital gain rate is lower than the income rate is, tax rate is. So, the more we could take advantage of long-term capital gains, the better off we'll be from a tax perspective. So what we'd like to suggest is a strategy called asset location, right? I kind of alluded to it before. Now, we know that asset allocation is, how to invest between stocks and bonds, but asset location takes into consideration your different accounts, and specifically how each account is taxed. So whether the underlying investment inside your IRA, for example, is a bond or stock, remember when distributions are taken, you pay ordinary income taxes based on your particular tax bracket, right? Also, if you hold a stock investment in your brokerage account, so that's a taxable account, then you may be eligible for the more favorable, lower long-term capital gain rate. Any qualified dividends generated in that account could also be subject to the lower, again, more favorable long-term capital gain rate as well. And finally, for those of you who may have Roth IRAs, remember that qualifying distributions are completely tax-free. So any assets in those accounts have the greatest tax efficiency to you. So as you can see, putting investments in the right types of accounts can be very, very helpful for you in retirement. And indeed, a lot of people have done, especially when the markets were at all-time lows, they converted their traditional IRA to a Roth IRA. Now you have to pay taxes on that, but because the markets were at lower rates, or was at a lower rate, the tax bite wasn't as big for folks. So that's something that you can consider as well. Here's sort of a graphical illustration of what we mean by that. So, we know that dividends that are generated from most real estate investment trusts, for example, or preferred stocks, are subject to ordinary income tax, whether they're held in your IRA or they're held in a taxable account. Now, we also know that bond interest is subject to ordinary income tax, again, whether held in an IRA or held in a brokerage account. Also, mutual funds that are deemed high turnover, and that's something that most investors don't look at. There's something called a turnover rate for your mutual funds. If you hold mutual funds in your taxable account, you may want to take a look at the turnover rate, because if it's high, in other words, over 100%, well, chances are you're going to be paying taxes, short-term capital gain taxes on those gains. And that's a higher rate than long-term capital gains. So just bear that in mind, okay? Now, for tax purposes, the investments, these investments would be best suited to be held in an IRA account. So anything that you have that's a high turnover mutual fund should be kept in a tax deferred account. Any investment where you can take advantage of the more favorable lower term capital gains rate, like buy and hold stocks, well, that's best suited for your taxable account. And what a lot of people do is they hold their S&P 500 index in a taxable account. Also, municipal bonds, that's great to have in your taxable account as well. Also, I'll just give you this stat because I found it interesting. According to a Vanguard study, just by employing the things that I talked about, asset location management, you can add a return of 75 basis points. So almost 1% of return to your portfolio on a yearly basis just by doing this. So another issue that comes up to being tax savvy is the withdrawal order. Okay, so in other words, from which account do you draw from first, second, or third? Now, there are exceptions to the rule, okay? But generally speaking, for most folks, it may make sense to take their taxable assets and withdraw those assets first, and then tax deferred accounts, and then lastly, because they're going tax-free, take from Roth accounts last. So as you can see from the second bullet here, the basic rule of thumb is the longer an asset can remain tax deferred or tax-free, the better it is for your portfolio in terms of performance. Now, there are some important exceptions, right? So the first has to do with retirement accounts and required minimum distributions. So if you're 72 or older, you need to make sure that you can satisfy your required minimum distribution, otherwise known as RMD, because the excise tax for not taking an RMD is as high as 50%. Also, for those clients who own company stock inside of their 401k, if the stock has appreciated a lot, you may want to consider a strategy known as net unrealized appreciation, quote unquote, also known as NUA, where you can forgo a rollover, right? So you're not rolling over the stock, but you can take a distribution of the stock in kind and convert the lion's share of that growth into a more favorable long-term capital gain, okay? Now, the downside is that ordinary income tax has to be paid immediately on the cost basis of the shares that you own in your employer stock. But certainly if you're interested in this, or if you're in a situation where you hold a lot of employer stock in your 401k plan, best to work with your accountant just to have a clear understanding of your tax ramifications. Lastly, beginning in 2013, we got a new tax called the Medicare surtax. Medicare surtax, yes. This applies to net investment income, right? Which is largely your dividends, interest, and capital gains. It also applies to higher income individuals. So those folks who have income over $250,000 if they're married, or over $200,000 if they're single. It's important to note that retirement distributions are exempt from this 3.8% surtax. So you don't need to worry about this tax on the distributions, but, and this is the big but, remember RMDs get added to your adjusted gross income, right? And that could trigger your 3.8% surtax on these other sources of income. So again, something to watch and something to work with your CPA or accountant. So principle 6, maximizing Social Security retirement benefits. Just by the way, guys, I do a whole hour on Social Security just in and of itself. It's just a very complicated a benefit that we all get. And the question that a lot of people have on their minds is, when should they start taking Social Security, right? And the answer is that you can begin taking Social Security age 62, the earliest, right? Or as late as age 70, or any time in between. So many people begin to take Social Security at their full retirement age, or also known as FRA in Social Security jargon. Your full retirement age is going to depend on your birth year. So for example, for those of you born between 1943 and 1954, your full retirement age is 66. I was born in 69, so my full retirement age is 67. Now, in terms of the breakdown and at what age do people apply for Social Security? So 57% of people apply for Social Security before their full retirement age. That's mind-numbing, and it's wrong on many reasons. There are some people who don't have longevity in their family, or they don't have income coming in. I understand that, but 57% of people taking it before their full retirement age is crazy. Why? Because you're leaving money on the table, and we'll talk about that in a second. 34% of folks take Social Security at age 62, the earliest that you can take it. Again, leaving money on the table. 3.7% of people take or apply for Social Security at age 70. And if you recall, age 70 is when you apply for these delayed retirement credits of 8% a year for 4 years. So 32% increase in your Social Security benefit if you wait to age 70. Only 3.7% of people apply at this age. Now, you might be interested in taking your benefits as soon as possible, right? Which is age 62. But if you take it at age 62, your benefit's going to be permanently reduced, okay? And that reduction is 25%. So you're leaving 25% of your Social Security benefit on the table. So if your full retirement age is, let's say, let's say you get $1,000 a month, but you apply early for Social Security at age 62. Your monthly benefit is going to be $750, okay? Of course, if you begin taking Social Security when you hit your full retirement age, right, then you get 100% of your benefit. For those who choose to delay past the full retirement age, and again, that's between your full retirement age and age 70, you get 8% increase up into age 70. So that if you do the whole 4 years, it's an extra 32% increase in your Social Security benefits, okay? So let's suppose that my full retirement age is 66, but I waited to age 67 to claim Social Security. So in my example here, if my full benefit is $1,000 per month, but I wait 1 year, I'll be entitled to the 8% credit, right? So now my monthly benefit is $1,080, right? Of course, if I wait until age 70, I'll get those 4 years of delayed credits. 8% times 4 times 8% is 32. So my benefit increases to 32%, right? So a big, big difference in how much I'm going to receive on a monthly basis. So let's take a quick look at another case study. If you have a monthly benefit of, let's say it's $12.50 a month, taking it early at 62 results in a 25% reduction, right? Which would decrease that monthly amount to $937. On the other hand, if you wait until age 70, you get those 8% credits that lead to a monthly income of $1,650 per month, okay? A difference of over $700. Now, again, while everyone's situation is different, I think we can all agree that difference is pretty significant, by and large, on a monthly basis, no less. So again, it's easy for me to sit here and say, well, just wait to age 70. I mean, in a vacuum, makes perfect sense. But we all know that there are other things that come into play when applying for Social Security, right? Generally speaking, for folks who are in good health, who have better than average life expectancy, and who have the financial resources, we'd suggest they wait as long as possible, right? So a guaranteed 32% increase is a great rate of return. For folks who are not in good health, or for people who don't anticipate a better than average life expectancy, and when I've given this presentation in person, there are people who come to me and say, look, my family tends to die out in their 60s. Obviously, it makes no sense to wait till age 70. Take it as soon as you can, right? So as you can see, there's no right answer, and it's going to vary from person to person. So it's very important to work with your financial advisor who can sort of assess your particular situation. They can run the numbers for you and hypotheticals to make sure that you make the right and informed decision. And along with that, I would also suggest going to the Social Security Administration's website. They've added some very useful tools to help you figure out how much you can expect and at least be more informed when you're making this big decision. Breaking even, right? So the question that comes up more often than not is, do I wait to age 70 and get that extra 32% monthly? Or do I take it as early as 62, right? So the answer is really a function of two variables: how long you live and the current interest rate environment. So by waiting to age 70, right, and having to use other funds, there's an opportunity cost, right? Because now I'm pulling money, I'm saving on Social Security, that's great, but I'm pulling money out of my other accounts. That might not be great depending on how much money I've saved. So just something to keep in mind. Now, what's the break-even point? So according to Social Security, it's 12 years. What does this mean? Well, if you guys take or apply for Social Security at age 62, and I decide I'm going to wait until age 70 to take Social Security, my break-even point, in other words, I will catch up to all the money you've taken out of Social Security at age 62. My break-even point is 12 years. So I need to make sure that I live to be at minimum 82 years old. And who knows, right? And that's the gamble that we all take. And remember, Social Security is run by actuaries. So they've kind of taken all of this into consideration. But that's by and large the break-even point that most people want to know about. So I'll leave you a couple of action steps on for this particular principle here. You know, there are some very interesting and complicated strategies that are out there. So make sure you work with your financial advisor to figure out what's best for you. As we saw, you know, you can take your benefits early, you can wait, or maybe take them at your full retirement age. As we talked about, you know, there are a number of factors that go into that decision. So if nothing else, I'd recommend going to the Social Security website and figuring out how much you expect to receive in each scenario. And finally, remember that through early application, in other words, claiming benefits early, a lower earning spouse can begin receiving their spousal benefits, so bringing money into the household, and then that you can switch over to your if you're the higher earning spouse, to your own Social Security benefit at age 70, maximizing how much money you're bringing into the house. Simple strategy, I know, but it's one of the only ones that are available to us because restricted application and the others are you can no longer use them. Unfortunately, they've been phased out. Finally, we'll touch on briefly on guaranteed income solutions. So annuities, I say the word annuity and people have their opinions, strong opinions. However, if I asked you, how do you feel about a guaranteed income stream for the rest of your life? That's a different question. And people tend to respond to that question more positively. Now, for those of us who are older, we remember the annuities in the 80s, how expensive they were. And yes, annuities definitely, generally speaking, are more expensive. By the way, Janus Henderson is a mutual fund company. We do not sell annuities. So this is not an annuity pitch, guys. But I need to say that because annuities do have a place in a portfolio. What do I mean? Earlier in 2020, when markets were going crazy, down 50%, and this is a personal story, I was in on a Zoom with family, and all my teacher relatives, or educators as they like to be called, they weren't worried. They were retired, they or close to retirement, and they didn't care. Why? They will get pensions. So it doesn't matter what the markets do. They know once, their pension's going to be X amount of dollars every month for as long as they live. Well, an annuity can do that. Again, it's a little bit more expensive, right? Because you're buying an individual policy, but an annuity can generate guaranteed income stream for us. Now, I'm not saying for everything. I'm not saying if I had $500,000, I'm not saying put all $500,000 into annuity. I would add up my needs. So on the slide, that bottom of the pyramid, right? So my food cost, my rental, my mortgage, my car note, if I have one, add up your needs, come up with a number, and then maybe purchase an annuity that covers just my needs. So no matter what happens in the marketplace, I'm going to get that check year in, year out, and everything else. And we can, you can do whatever you like, but just an idea, guys. Again, needs aren't, annuities aren't for everyone, but they are being used more and more. Also, another job that I have is that I work with 401k plan sponsors, and a lot of 401k plans are adding annuities to the 401k plan. And this has been blessed by the Department of Labor. So plan sponsors have safe harbor to offer these products in a 401k plan. So again, something to consider if you have a need. So with that, I'll close out today. I definitely thank you for your time, especially, so close to Memorial Day weekend. And with that, I will turn things over to Bonnie.
Oh, thank you very much, Ruben. Before we finish, I want to show you a calculator that might help summarize a lot of the things that we talked about today. So can I, maybe can you stop sharing and like get back the screen out, show somebody the calculator,
Sure.
and then I'll share the link with everybody. Okay, so let me see if I show you this link. Share. Yeah, can you guys see this calculator? Your retirement timeline, can you see?
Mm-hmm.
Okay, so this is very, very interesting because you can add in expense and income and everything. So let's just use this as an example. Your current age, I'll say 55. What age do you plan to retire at 65? You can change it to 67, whatever you want, okay? And how many years do you spend, do you plan to spend in retirement? I mean, okay, so maybe 20, I don't know, so 87, that's probably good enough, right? So next. And then, so based on your timeline, okay, you have 12 years until you retire. So I am 50, 60, 55. Let me see, what did I say? 55. I'm 55, so another 12 years to retirement, okay? You can change that, right? So this is just an example. And then you plan to retire at 67, your full retirement age. I don't know what that is, so but 67. You plan to spend 20 years in retirement, so 87 would be, years in spent in retirement. The next, okay, so ask you to put in your income. So already like put in something, but you can change it. Okay, so this is what, okay, maybe you got more, let's say 500,000, I don't know. Okay, and then how much do you want to contribute each month? You decide. So I still have 12 years, I don't know, so maybe I can do more, $500, I don't know, so whatever. Okay, and then you estimate. So if you want to be more pessimistic like that, more aggressive like this, let's say 5%. Let's not be too aggressive or too pessimistic. Save changes. And I put in Social Security. You go on the website and take a look and see what you're gonna get from Social Security. Maybe, if you make more money, maybe $2,000. Let's say 1,500. That's the average. Yeah. And then you can add another income source. If you have a pension or something, you can add it here, whatever, pension, but I don't know. So we don't have all like a annuity payment. So let's just stop here, okay? So, and then, okay, taxes. We cannot underestimate tax. So at retirement, what do you think? 20%, 15, whatever. Okay. So I would say, you know, if you still have some income coming in, like they're not going to let you go unless you pay something. So 15 to 20%. Let me just put 20%. And then after that, okay, so you have 2 retirement income sources. Total income would be about whatever, okay, per month. And then tax rate 20%. So that lowers it down from 7,600 to 6,000 something. Next, okay. Now here, expenses, right? We cannot ignore that. I don't know, whatever your housing is. Let's say, okay, I downsize, I moved to Florida, somewhere cheaper. I don't know what it is. Let's say 2005. I don't know, really don't know. Okay. You estimate, you put this, and then it has all these buckets, like where you can put all utilities, household, it's very detailed, right? It's a calculator free. So you can keep track, you can try food, maybe 200. I just putting in some numbers. Debt, whatever. I hope you don't have any more debt. Healthcare premium, it's expensive, right? So 350, 500, I put 500. And then what's good about this, it has inflation. Okay, inflation I'll put in, right? Okay, don't forget about inflation. 2%, okay, for 12 years is 1.27. It's not whatever, 100%, 127% of your estimated expense. So don't forget about that. And they estimate 4% rise in healthcare. Healthcare is more expensive. So instead of like 2%, it's 4%. So there you go. So it helped you estimate, do all this estimation. All right, done. You can fix this. Okay, you see, this is how, you know, so okay, instead in 12 years, instead of 2005 becomes 3001. Food, I mean, so we added the inflation factor. So 3007 here, be 4008. So next, now let's calculate your retirement income gap. Am I making it or not? So see results. Oh, fantastic. Oh, yeah, I got it covered. So if it doesn't work, then you go back. Okay, what you do, change. Let's say if I want to retire, I know this is not going to work. Let's say if I, okay, 67. I know if I add 10 years, I'm pretty sure I need more money. So let's say 30 years, so 97. So if I do this again, then I know most likely, so I will be able to cover. All right, let's just go here, see results. Oh, I still, but you get the point. You can go and fix your variables. Okay, like maybe you want to put more income, like save more. You go in here and change it, or change the return. You know, you don't need to go 6%, maybe 4%. You can play around with it, and gives you an estimate. So it's not the final thing, but it will at least give you the direction. Am I doing the right thing? And then you can fix it, adjust it. I still have 10, 15 years, so I can play around with it. Just thought this is a cool calculator. This is what it is. I'm going to send it to you when I get the recording done, so you guys can play with it. Okay, that's it. Any questions? No. All right, I think we almost at our endpoint, you know, 12:30. So I'll let everybody go early, and as soon as the recording is done, I'll send a copy to everybody, including, you know, if you want to share the PowerPoint, I'll send it out too. Okay, thank you.
Thanks,
Bye-bye.
Thank you very much.
Thank you.
You're welcome. Bye-bye.
Bye, guys. Thank you, guys.
Uh-huh.